Hi guys, I'm Nicola McKenzie, founder and mortgage advisor at Dunham McCarthy Mortgages. And in today's video, I'll be giving you an idea on the type of properties that can be difficult to obtain a mortgage so that you can factor this into your house search and hopefully avoid any surprises. So guys, here at Dunham McCarthy, we are property specialists, mortgage brokers and advisors, and we also specialise in insurance as well. We deal with lots of options from high street banks to specialist lenders and can help compare mortgage deals to find the one that's right for you. We can also provide our detailed knowledge and expertise to make sure that you are fully informed of your options, and we can help guide you through the house buying process. So if that's you and you are looking to start your house search, or you've already started it and you want some advice, then get in touch, head over to our website and book in for a free of charge appointment today. So guys, a few things that you need to understand about this video and about how mortgage lenders work in terms of the type of property you're buying. When you're getting a mortgage, a major part of the application process is for the lender to carry out a valuation on the property before they approve your application. And what this would do is give the lender an independent confirmation of the property's value. So they'll check prices of similar properties in the area that have sold to make sure that the value of your property is at the price that you've agreed to pay for it. The valuation will also tell the lender if there are any features or significant defects that could affect the property's value. Now, what you have to remember is that the property represents the security for the mortgage. So a lender will always want to be absolutely sure that if they ever had to repossess you because you default on payments, that security, that property, they would be able to sell it to recoup the costs and repay your outstanding debt. Now, whilst any valuation, so any property, depending on its condition and structure, can pose a risk to a lender that is just deemed too high for them to be able to offer you a mortgage on that property. But there are some types of properties that are commonly renowned to be more difficult to mortgage, and that's what I want to talk about today. But what I'm saying in this video, guys, is not that these type of properties necessarily you ought to avoid them all. That's not what I'm saying here. It's just that if you do decide to look at properties of the following description, you really need to make sure that you get specialist advice and get in touch with us, because the lender choice will be fundamental to making sure that your mortgage application has the best chance of being accepted. So studio flats are typically more difficult to mortgage in some cases, and the reason for this is because lenders have a more stringent criteria compared to other types of properties. Now, arguably the reason for this is because of the small size of the property. There is a smaller pool of potential buyers out there that would be willing to consider a studio flat. In turn, what that means is that lenders are a bit more cautious when it comes to studio flats. Also as well, because again, typically of the small size of a studio flat, lenders are generally concerned that the value of the property may not appreciate as quickly as, say, a house would, or a 2 or a 3 bed flat, or a 1 bed flat even. Now, where it comes to lender criteria in studio flats, most lenders will ask for a bigger deposit. So typically the minimum deposit you can put down on a house is 5%, but in many cases, a lot of lenders would ask for more. Also as well, lenders will pay attention to the square footage of the property, and some lenders will say that the square footage has to be above a certain amount. That might be 30 square metres or 37 square metres. It will vary depending on the lender, but ultimately they are slightly more difficult to mortgage in some cases. Non-standard construction properties can be trickier to mortgage than those that are of standard construction. Now, when we're talking about non-standard construction, guys, that covers a massive wide range of properties in the property world. Ultimately, a building or property of non-standard construction is anything where the walls are not made of brick or stone, and where the roof is not made of tile or slate. So we're talking about a massive range of properties here. You know, think of ex-local authority houses that are quite often made from concrete, to eco homes, or quite frequently, you know, the kind of thing that you'd see on grand designs. They're usually non-construction or non-standard construction, shall I say. Now, the reason that non-standard construction properties are trickier to mortgage is because improper maintenance can lead to the property losing its value quite quickly, and that can make it hard for owners or mortgage lenders to recoup any losses. It can also be more costly for insurers to pay out on any claims if a property deteriorates or is damaged. So therefore the lenders just feel that it's a little bit more risky in terms of recouping their costs. Again, if you were to default on payments, that is what it's all about when a lender is assessing risk as far as the property itself. So the usual criteria will apply when you buy a non-standard construction property, but lenders will quite often ask for bigger deposits. So where the minimum is typically 5%, you know, you will be expected in many cases to stump up a much higher deposit if it's a non-standard construction. But again, because non-standard covers such a broad spectrum of different property types, it does depend on the specifics of how the building is constructed. So again, make sure that you get in touch, guys, because some types of construction can be more problematic than others, and it really depends on the individual property itself. Now next, let's talk about flats again, but now we're talking about flats above shops. Lenders can be very fussy about this, and the reason is because it stems from concerns that the property ultimately would be harder to sell, in most lenders' opinion, compared to if that property was in a wholly residential area. So they see it as added risk. Now, one of the other things that composes an added layer to that risk is where the property is above a shop. Now, it does depend on what type of shop it's above. So for example, being above a hairdresser or a takeaway shop is going to make it harder because there's an increased risk of fire hazards from the shop down below. So generally anything that can affect the property through things like noises, smells, unsociable hours, that is going to make it harder to mortgage if you're buying a property that sits on top of a premises that trades and produces any of those things or problems. Lenders would typically want the flat as well to have its own self-contained entrance, not to be accessed via the business premises. Now, there are, on the flip side of that, plenty of lenders that will allow flexibility and will accept properties above commercial premises. But again, ultimately, it's always going to come down to the valuer's comments. By that, when they go out and inspect that property, it's down to the person inspecting it as to how high they deem that risk to be, if you like. And we know lenders, again, that are more accommodating with properties being mortgaged above shops compared to other types of properties. So again, just make sure that you get advice from us. Now let's talk about new build properties. Now, it should be no secret that buying a new build property often comes with a premium. You pay a premium with most things for the advantage of being the first person to use it. It's the same if you buy a new car. You would usually pay a premium for driving it out of the showroom compared to if you buy a car that's a few years old. And therefore, most lenders will require a bigger deposit on a new build home. Now, the reason for this as well is because lenders feel that it can be a little bit more difficult to resell a new home at a fair price whilst the home builder is still selling new houses that are on that site. So buyers, you know, if you've got two houses that are at a similar price, a buyer is usually going to opt for the brand new one over the one that's maybe a few months or a few years old. So that's also a reason as to why lenders will expect you to put down a slightly higher deposit. Now, if you're looking at using the Help to Buy scheme, then it's not usually an issue because a lender will accept the equity loan as part of your deposit. So where with the Help to Buy scheme, you would contribute a minimum of 5%. You would then get an equity loan from the government of 20 or 40%. Then the lender would consider that 20 or 40% also to be a part of your deposit. So it's not going to be an issue in that scenario. But if you're not using the Help to Buy scheme, then there are some lenders around the 5% deposit mark, but most lenders will insist that you're putting down a 10% and in many cases even a 15% deposit to buy a new build property. So next, let's talk about short leases. Now this obviously only applies to if you're purchasing a leasehold property, and that's where you own the property but not the land that that property sits on. The land is rented from what's known as the freeholder. Now at the end of the lease period, the ownership goes back to the freeholder. So the shorter the lease, the less the property's value and the less desirable it can be, more difficult to sell. Now you can usually extend a lease on a leasehold property, but that usually comes at a cost. And until you do, it's going to potentially affect the pool of potential buyers for that property. Now on the plus side of that, you can usually pick up a property at a discount, but as far as a lender is concerned, they are going to be reluctant to lend on a short lease. Now, what exactly do I mean by a short lease? Now, usually it's really only something that you need to consider or take into account if you're buying a leasehold property where the lease is less than 80 years. If the lease is 80 years or less, then again, you need to get specialist advice from us, as with all of the property types in this video, but ultimately the lender criteria from bank to bank is going to vary. Some will outright not accept properties with a lease less than 80 years, some will, but they insist that there's at least 35 years left at the end of the mortgage, as an example. It's going to vary from bank to bank, so get in touch. So next, let's talk about derelict properties. Now, for most lenders, a house has to be habitable in order to obtain a residential mortgage on it, or a flat for that matter, or apartment. Now, the minimum requirement for a property to be habitable is usually that it has a usable kitchen, a usable bathroom and a watertight roof. You're unlikely to get a mortgage for a property that isn't in a habitable condition from most lenders. Now, why you often see derelict properties at auction or being advertised as cash buyers is because obviously you don't need to involve a mortgage lender. So derelict properties, whilst they are great for picking up a bargain, if you have a mortgage involved, then you may not be able to finance it. Now let's talk about properties under the value of £50,000. Now there are some lenders that will lend on properties of a lesser value than £50,000, particularly for investment properties, but it does get limited. So again, just another one to look out for. If you are buying a house less than 50k, then again, you need advice from us. Now, generally, the reason that lenders are funny about this is because the margins are tight. Think about it, you know, if you're looking at an investment property, even a 25% deposit on a purchase of 40k, that's not leaving much of a margin in terms of equity. So in other words, the lender's going to have less confidence that they can recoup costs in the event of you defaulting on payments. So that's why they're just a little bit more cautious, but there are options, so get in touch. So now let's talk about high-rise flats. Now, lenders might even refuse to grant a mortgage outright for a high-rise above a certain level. Now, the criteria, again, as with any mortgage, is going to vary amongst the banks, but it can be tricky to get a mortgage from anything, usually from the 4th floor of a high-rise upwards, depending on the lender. Now, this is due to the fact that historically lenders have had concerns about high-rise properties being able to retain their value and appreciate in the same way that a house or say an apartment style building might. Now, if you live in London, for example, then you might find it easier due to the location and the popularity. As it's a more densely populated area, high rises are more common, so the rules might be relaxed in those areas with some lenders, but ultimately, again, you just need to seek advice. Now, again, guys, disclaimer, what I'm saying in this video is not that you cannot get a mortgage if the property you're looking at buying falls into any of the above categories. What I am saying is that you need to get advice on how to best navigate through the choice of lenders, because they're all going to view that purchase very, very differently. So make sure that you head over to our website, dm.mortgage, and book in for a free of charge appointment so that we can help you to make sure that not only are you getting the best mortgage, but that you're getting the best advice throughout your house buying process. And like I said in the intro, we look at lots of different banks and building societies to compare the options and make sure that you're getting the best deal. So head over to our website and make sure that you subscribe to the channel if that video has been useful to you. And I assume it has, because you've stuck around this long. So I'll see you in the next one.